How credit scores work. The number that quietly decides a lot. There is a number attached to your financial life that most people do not think about until it suddenly matters. It can affect whether you get approved for a loan, how much interest you pay, and sometimes even whether you can rent a place. That number is your credit score. It is not something you directly control day to day, but your actions constantly influence it. And the rules behind it are not always obvious. So today we are going to walk through how credit scores actually work and what is really going on behind that one number. Chapter 1: What a credit score is. A credit score is a numerical representation of your creditworthiness. In simple terms, it is a measure of how likely you are to repay borrowed money. Lenders use this score to decide whether to approve applications for loans or credit. A higher score generally indicates lower risk. A lower score suggests higher risk. Chapter 2: Where the data comes from. Your credit score is based on information in your credit report. This report includes details about your borrowing and repayment history. It may include credit cards, loans, payment records, and account balances. Credit reporting agencies collect and maintain this data. The score is calculated using this information. Chapter 3: Payment history. One of the most important factors in a credit score is payment history. This reflects whether you pay your bills on time. Later missed payments can negatively affect your score. Consistent, on-time payments tend to improve it over time. This factor often carries the most weight in scoring models. Chapter 4: Credit utilization. Credit utilization refers to how much of your available credit you are using. For example, if you have a credit limit and you use a large portion of it, your utilization is high. High utilization can signal higher risk to lenders. Lower utilization generally has a more positive impact on your score. Chapter 5: Length of credit history. The length of your credit history also plays a role. This includes how long your accounts have been active. A longer credit history provides more data for lenders to evaluate. Newer accounts may have less impact initially, but they still contribute over time. Chapter 6: Types of credit. Credit scores can also consider the variety of credit accounts you have. This may include credit cards, personal loans, or mortgages. Having a mix of different types of credit can provide a broader picture of your financial behavior. However, this is typically a smaller factor compared to payment history and utilization. Chapter 7: New credit activity. Opening new accounts or applying for credit can affect your score. Each application may involve a credit inquiry. Frequent inquiries in a short period can signal higher risk. This may result in a temporary decrease in your score. Chapter 8: How scores are used. Lenders use credit scores to make decisions about lending. A higher score may lead to better interest rates and terms. A lower score may result in higher costs or declined applications. Credit scores are also sometimes used in other contexts, such as rental applications. Chapter 9: Changes over time. Credit scores are not fixed. They change as new information is added to your credit report. Positive actions, such as consistent payments, can improve your score over time. Negative events may lower it, but their impact can decrease as time passes. This means credit scores reflect ongoing behavior rather than a single moment. To wrap up, credit scores are numerical summaries of your borrowing and repayment behavior. They are based on information in your credit report, including payment history and credit usage. Factors such as utilization, account history, and new credit activity all contribute to the score. Lenders use this number to assess risk and determine loan terms. Although the system can seem complex, it is largely driven by consistent patterns of financial behavior over time. This has been a mini Leviathan production. If you enjoyed it, check out our other videos. See you in the next one.